You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast with the first episode of 2021. Good riddance to 2020. I am looking forward to a very, very fruitful, exciting 2021. I'm looking forward to us having in-person events. I think it's going to happen. I think it's going to happen, hopefully, in my opinion. I think this will probably be sometime in the summer, is my guess, when we are actually able to meet in person for a Wealth Formula event. In the meantime, we have so much to look forward to. And, you know, I've said it before, and I do believe this to be the case. I don't think that we're out of the woods in terms of some short-term financial bumps in the road. I think we are. It's very possible, sure, the next 2-3 months. But understand, once again, the investments that you make today are not for the next 2 or 3 months. They are for the next 2-3 years, 4 years, 5 years, etc. And so for that reason, it is important for us to understand and to act on sort of the long-term vision, okay? And for me, one of those things is, where to start. So I've talked to a number of people who, over the years have, sort of floundered and, thought, they've made a bunch of money, they have a bunch of money in the market, and all of a sudden they've come to our paradigm, sort of wealth formula, personal finance paradigm. And they ask me, where should I start? Well, I don't like to give financial advice, but if it's me starting back just after surgical residency, it would be with these products that we have come to know under the umbrella of Wealth Formula Banking. So let me tell you the story. I think I might have told you this once before, but it's worth repeating. When I finished surgical residency, and this was, 2008, 2009, whatever. So I took a job, and it was with a cosmetic surgery company for a few months before realizing that I really was not employee material. I was really an entrepreneur. Anyway, that's another story altogether. There was a hodgepodge of group of surgeons there at the place that I was working, and some of us were younger guys who recently finished training, looking for some experience. There was also, of course, some of the older guys who had failed miserably in private practice and had become the so-called, as they call them in football, right? The journeymen. They were doing work in multiple practices and businesses just to make ends meet. So, it was at that time that I just finished reading Robert Kiyosaki's Cash Flow Quadrant, which, as you know, was a major influence on the trajectory of my life. I was finally making some money on my own following several years of, minimum wage indentured servitude as a surgical resident. So I was receptive, to financial advice. I wanted to know what others were doing who were successful. And I remember one time asking a 60-something-year-old surgeon, what he would have done differently if he could do it all over again. And remember, these guys who were in their 60s, who were working there, they didn't do very well. So they were the ones who'd made some bad financial decisions. And so I kind of wanted to know, what did you do wrong and what should I not do? And so now this guy, again, had really not managed his finances well and was still having to crank it out just to get by. By the way, this is now, again, 2009 or so. He just got crushed by the stock market. So he needed to work longer and for more years than he thought. So I wasn't really looking for him for, I didn't really care what he did right in his life. And that in that regard, I wasn't asking him for advice. I was more interested in what he did wrong, because that was equally valuable to me compared to what others might have done right. So when I asked him what, he would have done differently, what kind of decision in hindsight he would have done differently, he said, well, I would have, and without a flinch, he says, I would have bought more permanent life insurance. In fact, he said, quote, "In fact, that's all I should have done." Now, okay, again, why would he have said that? It's a complicated question, but I think I know the answer, and we'll get to that later. But at the time, admittedly, I was a little confused by his answer. You see, I didn't even know at that time what permanent life insurance was, and it never occurred to me that buying life insurance in any capacity would actually be considered an investment. So as it turns out, this poor guy made a lot of bad investments throughout his life, culminating in 2008. Stock market crash wiped him out and his plans to retire all in a flash. And I asked him that question in 2009. And the reason that he said that's all he should have bought, was the permanent life insurance was, well, guess what? In 2009, when the market went to hell, the only thing he had left was a permanent life insurance policy with cash value that had grown every year for 35 years. Every year for 35 years of 5.5%, compounding. He would have been way ahead at that point had he just done that. And now listen, I'm not telling you that's what you should do. I'm just telling you a story. And this guy's perspective. So, and as this guy was giving me his perspective, another younger guy who was, he was listening, and when the coast was clear, he came up to me and he said, "You know what? Don't listen to that guy at all." He said, "Buy term and invest the rest. Buy term and invest the difference," is what he said. That's what he said. And that's the first time I ever heard that phrase, but apparently that is like sort of a mantra amongst a certain type of financial, I guess, blogger or whatever. Well, this guy who told me that was just a year ahead of me, but he seemed really confident in what he said, so I listened to him. My wife at the time was pregnant with her first daughter, so I asked around, found a guy who was a Northwestern Mutual agent that all the doctors seem to use, and talk about the blind leading the blind, by the way. That is like your classic thing, like, hey, who'd you go to insurance for? Northwestern Mutual. And then the next guy goes Northwestern Mutual, and then there's no thinking involved whatsoever. And anyway, I did the same, bought some term insurance. I did look at the option of permanent life insurance, but frankly, first of all, I had the advice from the young whippersnapper that I thought was smart. And second of all, what I saw from the Northwestern Mutual agent that he was suggesting was, frankly, a complete and utter ripoff. It is the reason that most people who are against permanent life insurance are against it, because those are the policies they see, okay? The horrible ones. So the idea of life insurance as an investment really didn't come back to me until about 5 years later, and at that time, I was making quite a bit of money, making 7 figures with a couple businesses cranking, and during this period, I was also in a CEO group called Vistage with another guy who was an advisor to ultra high net worth individuals. And he and I got to be pretty good friends. I trusted him, and he was the first one to explain to me why so many affluent people, rich people, ultra high net worth people bought permanent life insurance products. So why did they buy that stuff if this young whippersnapper and these, characters in this space who like to, pretend that they are sophisticated investors, they all said the same thing, but, buy term and invest the difference. So who is smarter? Those guys, those doctors who, did a little extra reading, or the ultra high net worth folks who are making millions of dollars and passing on legacy wealth? That was what the question I had in my mind was. Well, I think you know the answer to that. And as it turned out, the older surgeon who was broke and the younger know-it-all that gave me their contradicting advice were both right. Permanent life insurance was indeed a powerful and reliable investment, and that's why so many ultra-high net worth individuals use it. However, the guy who told me to stay away from the permanent stuff was also right because the way most policies are structured and the way he saw it and it was presented to him were an absolute ripoff. It was an example of a pattern I began to recognize. You see, and this is the truth. There are products and investments that most people see, and they are the ones that only the wealthy people know about or qualify for. And once I realized that, I bought my first overfunded whole life insurance policy, but it was unlike the policy that I saw when I bought that first term insurance. I bought this policy not as life insurance. I bought it as an investment and as a strategy to augment the rest of my investments. And that was a big difference. You see, the type of policy I bought was so different than what everyone was talking about with the permanent life insurance that they frowned upon and cast aspersions on constantly, that I decided I needed to name this kind of policy, this different kind of policy that most people didn't seem to understand, and what wealthy people who are using this stuff did understand. And so I decided to call it something different. I decided to call it wealth formula banking. Okay? That's where the genesis of wealth formula banking is. I call it something different because it is something different, okay? Wealth formula banking is a wealth creation account more than anything else. It is an account that grows tax-free at a guaranteed compounding rate and has done so since the Civil War, through the Great Depression, multiple bank failures, and recessions. It's also a wealth magnification machine. So the idea is, while your money grows at a compounding rate, you can actually borrow money from the insurance company at a simple interest rate, effectively allowing you to grow your money in two places at the same time. There's an arbitrage there that is critically important to understand. Anyway, any cash flowing investment can be essentially enhanced by simply leveraging cash value and using this arbitrage of simple versus compounding interest to your financial advantage. It's like double dipping your investment capital. And that's really, that's the way I think about it. When I finally got a policy, all I could think of, honestly, was, why didn't someone tell me about this 5 years ago? Well, the answer to that is really that most insurance brokers are not going to show you the overstructured stuff because they are not as profitable for the brokers. That's just the truth. They have to be optimized for cash in your pocket. Now, going back to that friend that I was telling you about from the CEO group, now what he was talking about was different from this whole wealth formula banking concept that I just described. He was talking about a completely different kind of investment strategy that, frankly, this is the one that you see a lot of ultra high net worth folks doing, like a lot, most of the ultra high net worth or family offices that I'm aware of use this technique. It's a different kind of policy because instead of growing at those fixed rates and dividends like wealth formula banking, it grew with the index of the S&P 500. So in that concept, the account would give me essentially all the upside to the market, but none of the downside. In other words, you can make money up to a certain percentage, but if the market were to lose money in a given year, you don't lose money. And then on top of that, you use bank leverage to multiply the upside gains. Now, that kind of policy goes by a lot of different names, and the ones for the ultra high net worth people that that use it in terms of what's called a life insurance retirement plan, they may know it as a premium finance index universal policy. And that was really only at the time that I heard from my friend about this, only available to people making 7 figures plus, or had like a net worth of $5 million plus. But since then, Rod Zabriskie and Christian Allen and I were actually able to identify some variations to that model. What we call Velocity Plus, that can actually be used by anyone making as little as $125,000 per year. Anyway, as you know, I'm a huge supporter of these strategies. And given the volatility of the stock market and the potentially systemic risk of ETFs and mutual funds, that the likes of Michael Burry have identified. I think it's important for everyone to truly understand the impact that these types of policies can make on your future and also to the future of your children. And with the new year here, I think it's important for all of us to start with some basics and ask the question, what's important? What's important? The most important thing in personal finance is not to lose money and, in my opinion, to secure the future of your children. So anytime someone comes to me and asks where to start, I tell them to start with wealth formula banking, because I really wish that somebody had told me about it even earlier than I was able to discover all of these concepts. But again, the noise out there against these types of products is constant, and it can make you uneasy. I mean, prominent financial bloggers, particularly in the medical space, for some reason, in particular, create this sort of plethora of poorly understood comments regarding these types of policies. And all I can say is, I just don't think you understand, man. I just don't think you get it. And that's not a surprise, because most doctors don't. Anyway, today we're going to pick apart some of those criticisms and try to give you some perspective with Christian Allen and Rod Zabriskie. Again, in my opinion, wealth formula banking related products like this should be a starting point really for any high net worth financial plans. So it's appropriate, in my opinion, for us to start with this topic in the new year. So make sure to listen to this episode with Rod and Christian when we come back. Welcome back to the show, everyone. Today, my guests on Wealth Formula Podcast, I'm sure are familiar to you by now. They are Christian Allen and Rod Zabriskie of Wealth Formula Banking fame. They can be found at wealthformulabanking.com. That's the site you need to go to if you're interested in these products. But, we're doing this show today because there is an absolute assault on insurance products from various factions of the financial world. We know about the Susie Ormans, we know about the, Dave Ramsey and all that. But even in various niches, specifically in the doctor world, there seems to be this unusual attack on insurance products that involve investments. And I kind of get it. Because when I first got out of training, there was this massive misinformation trail that I kind of walked into when people started talking about investments and life insurance as well. And you heard the people say things like, oh gosh, no, never consider permanent life insurance. You do term and you invest the difference and all this. And so I thought that was for real. But then I looked around when I started making real money, not just doctor money. And it looked like everybody who was high net worth was using these products. And I was like, what the heck? So that's when I did a deeper dive and I started to figure out why. Okay. So I understand it, but there's still so much noise out there on the opposition, creating this sort of sense that somehow these products are nefarious and so on. It's kind of crazy. So rather than, just sit there and listen in quiet desperation the way we have been, I offered Christian and Rod an opportunity to come on and refute, a specific blog by a specific well-known blogger. And we won't talk about names, but I think it's a good opportunity for us to do that, because I think a lot of this kind of same stuff keeps coming back again and again and again. So with that, Christian and Rod, welcome back to the show.
Hey, thanks, Buck. Thanks for having us. Man, we're excited to be here. We like insurance, so this is a topic we're happy to discuss.
I like it too. I like it too. Well, okay, so we've been talking about this for a while, because these I almost feel like these are kind of directed at us or something like that. I don't know. It's weird.
And they just keep coming back, right? Every 6 months, or they just keep coming back. They're very popular, I gotta say.
I know it's very strange because there's an intensity about this which I don't quite understand. But let's get into it, right?
Okay.
Because there's this article that basically this blogger wrote, and there was 10 points of why, why. Basically, I don't remember what the name of the article was, but that you shouldn't mix insurance with investing. And that was effectively it. And we are obviously on the opposite side of the fence there, where we believe that it makes a beautiful combination. And we're not alone in this because the wealthiest people in the world are doing the same. So let's start with this, this it's almost like a David Letterman top 10 list. But on this, it starts with number one, and this one cracks me up a little bit. But he says the doctors get fooled in this because of lack of financial sophistication. He says, quote, doctors aren't exactly in the same category as accountants when it comes to the financial world. Okay, so let me just say, first of all,
that might be the first problem.
Yeah, that would be problem number one. When you believe that your accountant is the one who is the sophisticated investor that you should be using as the metric by which you measure the sophistication in the financial world. Frankly, few accountants make that much money, and accountants know nothing about investing. But anyway, I'm going to let you go. Lack of financial sophistication. Christian Rod, what do you say to that?
Okay, so I have a lot to say to that, Buck. So the first thing is it's just the opposite, right? Like that's the great irony here is lack of financial sophistication is why people get sold products that aren't good, right? So there might be something to that. But when you talk about the financial sophistication, there's this really interesting trend that people, as they become more prolific as investors, they actually start to see the value of it. So what's happening is this first point, you can basically flip it on your head. And let me just say this, like one of the things that's challenging about an article like this is he's just putting a very broad umbrella over everything and maybe not suggesting and letting people know that these things can be tailored dramatically in different ways, right?
Rod, so I don't think he knows. He can't know. He can't know how these things are structured if he's writing this article. So go ahead, though. Go ahead.
Yeah, no, I think that's fair. And I think based on this and some other articles I've read about, he actually had one specifically about infinite banking as well. And I think he gets it to about 80%, but then there's just like this gap that's missing, right? And so what ends up happening is you paint this broad brush and you find yourself stating things that are just completely and totally inaccurate as it relates to the way that we do it. So almost everything in this list is going to be opposite to the way that we do it. He's going to talk about things like losing liquidity, and we're going to be and we obviously keep hitting on things like how incredible the liquidity is and that you can invest with it. Now, so a couple things. He may not understand how wealth formula banking works to its full extent. I would say probably doesn't, right? And then in addition to that, is undervaluing a lot of the tools that come with it, specifically as it relates to high income earners who are in a high tax bracket and who eventually could create a high net worth. So there's a couple of things. Yeah.
All right. Well, let's move on to the next because there's 10 of them. The next one. Well, okay. So mistaking an insurance salesman, that would be you guys, right? For a qualified investment advisor. Well, let me just start out with this question for you. What requirements does a qualified investment advisor have? It's basically a Series 65, right?
Yep, that's correct.
So just for clarity, Series 65. So my brother, who is a pretty he used to run one of the sovereign wealth funds in the Middle East. He's a smart guy. He used to work and before that he was at JP Morgan in New York and London, leveraged buyouts. But when he first started out and they were a bunch of bankers together and they all had to take the Series 65, they had this pool where they would see who could get closest to failing the Series 65 without failing. So I think the score was 72. And so these guys would sit there and try not to do really well. They had like literally a pool of money betting. So they were trying to hit 72 on the nose. Okay. So apparently, if you get this Series 65 done, you are, which I think he studied for about 3 weeks. Apparently, that's enough. That makes you know everything about everything. But anyway, go ahead. Obviously I've got my opinions here, but this is more about you.
Yeah, sure. I'm going to hit on this, and Rod can hit on it too. But the first thing is, this is a problem in the financial industry as a whole, right? The issue is less about someone's qualification as it relates to like the credentials that they got from licensing, because the bar for licensing across the board is really low, right? Whether you pass the 65, when I passed the securities test, I suddenly didn't know more than I did before that, right? So what's interesting here is we're putting all this stock in things like the Series 65. The health and life insurance license takes about the same time from a study perspective as the Series 65. So here's the deal. You shouldn't be, when you're evaluating who to work with and whether to work with someone, you want to be looking at things beyond just their licensing and credibility. You want to be looking at the track record, right? You want to hear what people say about them. That's why that's why we spent so much time getting client testimonials, video testimonials, things where people can see that we have a track record of doing it right for a long period of time. If you're relying on licensing as the source for wisdom about whether to work with someone or not, you're just headed down the wrong direction. It's really about who they are.
Yeah, and not only that, but let's be real here, okay? Are you saying then that investment advisors don't get paid based on you investing? No.
Right.
These are all financial professionals. Guess what? When you're investing in our syndications and I'm a general partner on there, I'm benefiting from that. That doesn't mean that you should be saying that that somehow I don't have your best interests. Absolutely I do, because if you don't do well, you're not going to come back and invest in one of my opportunities. That's a really important thing for me, right? So it's absolute nonsense to look and say somebody's going to benefit from your investment, your participation, and therefore it can't be good. That is the stupidest freaking thing I have ever heard. Okay, go ahead.
Yeah, well, and that goes back to another level of this problem, and that is that when he's talking about investing, he's talking about a very, very small definition of investing, right?
Right.
Because he gets into, stockbrokers and mutual funds and things like that. Well, let me ask you this, Buck. Is he leaving some things out if he's only talking about the stock market?
Well, he's not touching anything that I invest in personally.
Right.
And I guarantee you, I'll put my balance sheet up against his any day.
Yeah. So anyway, that, maybe
right.
that helps, define what we're going to talk about, down the road, but that,
next one's funny.
I think it's a really good point, right? But the reality is that everybody gets paid. And from my perspective, I want people that I work with to get paid. And I'm comfortable with that. And I think what happens is the reason that our relationship works out so well is because generally people who are builders, they understand the value of getting valuable advice, right? It's the same thing when you go to someone like Tom Wheelwright. You go to Tom because even though he costs some money, he's going to save you and provide a whole lot more value than he costs. And so again, it's just understanding the value proposition. And I would say just make sure you're going to people for their track record, not because they have a license.
And just to be clear, one more thing, that you can pad commissions and stuff like that. But what Rod and Christian are known for, one of the reasons why I've really aligned myself with them is really maximizing these policies to the point where they can't be any more slim on the commission side, frankly. Okay, next question. The belief that doctors need to invest differently than everyone else. This is a crazy, crazy statement. And I quote, 95% of what we need to do financially is no different from any other middle-class investor. Oh my God. If you believe that you are a sophisticated investor because your investments look like 95% of the middle class, Are you crazy? You're not sophisticated? Who's using these insurance products? Well, these insurance products are they high net worth people, not the middle class. The life insurance retirement plans. See, you can invest like the high net worth individuals, the wealthiest people in the world, or you can invest like the middle class. That's your choice. Anyway, what's your take on this?
Get this. I'm going to throw out a stat, Rod, and then I'll let you take it away.
Yeah.
But get this. According to the Medscape income report, they suggest that less than 50% of all physicians have a net worth over $1 million. That's less than 50% of all these people who are, making, I think they said an average of 237 for a general practitioner and 100 more if you're a specialist. But the point here is that there's a lot of physicians out there following the advice of 95% of what the world's doing, and they're getting the same results, right? They're getting the results that are leaving America broke by relying on things that just haven't been working, and they just keep doing it and doing it.
So these shouldn't look any different than the middle class. Anyway, number 4.
They won't if that's what they keep following.
That's right. You'll end up in the middle class. And I don't think you want to do that. I really don't. The shrinking middle class, by the way. So the next one, belief that insurance products provide asset protection benefits not available in other ways. I would say this. I don't think that anyone here has ever said that asset protection that there's not ways to provide asset protection that don't involve insurance. So I don't know why there's this idea that, anybody's claiming that they're not available in any other ways. I think the way we have positioned it, you guys have talked about it in terms of it's a way, it's an additional benefit. It's not, a reason, right? I mean, That's kind of the way I would look at it. I don't think having an additional benefit of asset protection is a bad thing, but I don't think anybody's doing this because of that. But anyway, go on.
I think that's completely true. And when we talk to people about it, it is on the list of benefits and features, right? And it is a cool one, right? The fact that you can put money in there and in a lot of states, it's going to be completely protected. Like that's a real value. If it's not that way, we'll also show how to do it regardless of whether your state has those kind of benefits associated with them. But like you're saying, Buck, that's not the reason to do it. It's not the reason to jump into them, but it sure as heck is a nice feature and benefit that comes with most states.
And along that line, belief that insurance products provide estate planning benefits not available in other ways. Now, in this one, I think he's right. If you are in the middle class and you're, if that's the money you got, but if you're high net worth, and some of our investors in our group are really ultra high net worth guys, they're making
many of them, yeah,
20,
sure.
30, 40, $50 million net worths. And in those situations, I'm sorry, but there is a lot of things you can do that are pretty unique to insurance. I mean, that's just a fact. You want to talk about that?
Yeah. And this one is the only thing I can assume is just ignorance.
He doesn't know. He doesn't know.
Yeah. Yeah. Because estate planning, you talk to any estate planning attorney and take away life insurance from their planning and ask them if that changes the way that they plan. Right?
Give us an example of something, because there's just so much out there. But just talk a little bit.
Okay, so two primary things, right? Number one is estate tax planning. What better way to plan for estate taxes than to create a situation where you have a lump sum of cash that comes into the picture when that happens, and again in the course of doing the regular estate planning, you put that inside of especially an ILIT, an irrevocable trust, and now we create a lump sum of money that lands outside of the estate, and the heirs are able to use that to pay the estate taxes. So that's one really easy. That's the low-hanging fruit, right? But then you think about other like liquidity that's needed at the time of the transfer in estate, right? So recently we've been working with somebody who farms, right, and wants to continue to build their kind of farming empire. And when they pass, and they're going to pass all that land and other hard assets to the next generation, liquidity, having some level of liquidity is going to be enormously important for them in their estate tax planning, or the estate planning, excuse me. And so again, the idea that life insurance doesn't have a role inside of estate planning, that you can't get in other ways, is just
It's
silly.
nonsensical.
Yeah.
And it's completely unsophisticated. I'm sorry, it just is. All right.
And can I just point out one really quick
Yeah.
thing? He mentions in there that the estate tax moves. It's up at 23 million, but it's been down. Like, here's the reality. Why would you go in planning? Like let's not go in planning and assuming that that it's always going to be as high as it is today or going to go higher. Well, that's a possibility, but
It's going to be
the
lower.
wise move to
Everybody
make-
knows it's going to be lower. It's probably going to be lower
That's
next
it.
year.
And
right.
ask your
So
kids.
let's.
Ask your kids, would you rather have the assets that I can build inside of, again, the 401k or whatever, or would you like to have income tax free money that passes to you? It's completely liquid. You can do whatever you need to at the time, when you're settling the estate.
This is giving me a headache, guys. All right. Next one. Belief that insurance products provide tax benefits not available in other ways. Well, I'm not sure who said that. I mean, I know there are tax benefits and tax benefits. Well, frankly, when it comes to tax benefits, we aren't even going to really acknowledge the idea that most people have strategies like ours in our area. But, insurance is just one more benefit. And again, it goes back to the idea that there is tax advantages to this and tax advantage growth, et cetera. But it's not. I don't know why that's a bad thing. I don't know. Anyway, go on.
Yeah. So here's a statement that he makes on this one. He says the main problem with investing in insurance is you have to quit doing stuff that keeps you from getting insurance at a decent rate. And here's a conversation that we have every day, and that is that the irony of what we do with wealth formula banking, for example, is that we don't pick life insurance because of the sake of the insurance. We pick it for the other benefits that you get, right? And then the insurance benefit is something that comes along as an added benefit. So, okay, so if he's saying, okay, go get a municipal bond because of the tax benefits you get there, Buck, would you rather have a municipal bond? Would you rather have a wealth formula banking policy? Right?
Yeah, that's not hard.
I mean, again, not that the tax benefits are
like
completely
maybe
unique in every aspect.
Maybe
right?
a municipal bond from Detroit or something. Anyway, go.
Yeah, I mean, so anyway, he gives examples. Can you get? Is there another place where I can put after-tax dollars into the place? It grows tax deferred and comes out tax free. Yes. Does that exist?
It's called a
Yes.
Roth IRA, right? We use the comparison all the time.
Yeah.
Like you're saying, it's not that it has every benefit of every, but it does as a grouping have a very unique grouping of benefits that's incredibly impactful for wealth building. Yeah. Sorry, I have a hard time holding my tongue.
Yeah, no, I get it. I think we all are, and that's why we're doing this finally, because finally the dam is broken.
I like it. Okay, I want to make a quick statement because I think overarching, this will help, right?
Yeah.
So I mentioned earlier that that he writes an article specific to infinite banking, and in there, and I think this goes to your point, Buck. There's just in here a lot of not understanding or misinformation or maybe just like really biased writing. But he says this: you're faced with a choice. You can put the money in the bank, you can invest it, or you can buy a be your own bank, infinite banking type policy. And so here's the irony there. What we're suggesting is not that at all. We would say you're faced with a choice, but your choice isn't to put the money in the bank or invest it or buy the policy. Your choice is to put the money in the bank, or you can put it in the policy and invest it. Right. So there's a very key element there that's just not being hit on. And that's the fact that we want to invest and we want to have the policy. We're going to do the two in tandem to optimize it.
The idea, once again, for anybody who's not clear about this, is that you can have this money grown at whatever 5.5% compounding, whatever it is at the time, right? You get you're fixed, and you've got your dividends. The dividends have been paid out through the Civil War, through the Great Depression, et cetera. So although they're not technically guaranteed, that's pretty guaranteed in my book. You can have that growth, that compounding rate growth, then you can borrow money from the general ledger of the insurance company while your money continues to grow at 5.5% and deploy that money that you're borrowing at a simple interest. So you've got a arbitrage of compounding versus simple interest that in of itself is going to make you money. That is what we've been pounding over and over and over again. It's not, first of all, compared to the bank, 5.5% compounding is a hell of a lot better. But that's not what we're even suggesting. We're just suggesting you take your investments and juice them up. If you look at our ATM pro forma, what was the difference there? Do you remember offhand? It was crazy. Rod, do you remember that? With and without banking.
Yeah, with what we added on, even if we didn't include the depreciation, on top of the investment returns that you got from the ATM, it was an additional $32,000 by the end of the 7 years.
Yeah, so $104,000 investment, which had, I think, over 7 years a $92,000 return, goes up to like $120,000. Okay, and that's real money. And all you did was allow your banking policy to help participate in this fund, right? That's all you did. The pro forma numbers. And so to me, that's the piece that's completely missing, right? If you don't even, we're talking about strategies. And that's what I don't think he either doesn't get or he doesn't want to acknowledge. That these aren't just investments either. They are strategies. So,
well, you know what happens oftentimes from my experience is that there is a lot of physicians who get who feel like they get taken because they buy a policy from the Northwestern agent down the street who's just selling the basic stuff, and like all of a sudden they look at it 5 years later and they're like, well, this thing's growing and now all insurance is just garbage, right? When in reality, it was the ironic part is that it was the lack of financial sophistication early on that created that situation. So if a physician, if you're listening to this and you're wondering about where insurance fits into your world, the first key is to learn about it and understand the basics, right? So that you don't end up getting a policy that's not built for cash value. Because here's one of we actually agree on a lot of things. However, like for example, we love term insurance. Instead of saying buy term and invest the difference, we'd say buy term and invest with wealth formula banking, right? So there's some really interesting ways to do it, but we're not that far off. It's just that those elements that we're off on create this kind of wide gap.
Right. And there's just this sort of sense that, it's my way or the highway, which honestly, I don't care if that's what you want to do and you want to invest like, the middle class and do your little index funds and stuff like that, then fine. That's not what we do. But I think pretending that you understanding that you don't, things that you don't understand and vilifying them and making them sound like they have no value when look who uses this stuff, right? I mean, look who uses the wealthiest people in the world. These are not idiots, right? So maybe you ought to look a little deeper and maybe you don't get it. Anyway, next thing here, misunderstanding the value of the guarantee. Okay, go ahead.
Yeah. So he says, is there a value to guarantee? He says, of course, it seems especially valuable in times of high market volatility or political uncertainty. However, in nearly every case, the buyer is overpaying for that guarantee. So again, this goes back to a lack of understanding specific to how the policies can be designed, right? So if you come and you work with us, he talks about in his other article how an agent getting paid commissions would get, 50 to 100% of the total premium. And what he doesn't realize is that in our case, 80% of the premiums going directly to paid up additions to cash. So it can't be. So it's this broad brush that ends up getting put over it that brings down the value of really every part of the insurance policy. But what I can tell you is that people who have been waiting for the right opportunities or saving up money to invest in particularly cash flow, real estate, things like that, they're really happy when they've generated that 5% tax-free return that they can move in and out of the policy. And of course, that especially applies during the times when markets are so volatile. But the important thing to remember here is that because of the way that the policies are structured, the way we do it, this is totally and completely false in the sense that the cost is so low over time that you're actually probably underpaying for the guarantee, if anything.
And to that point, the next one is about the importance of keeping insurance costs down. If you look at it over a period of time, we've talked about this before, but the cost over a period of a decade or so, what does that come out to?
Yeah. So when we play this out, again, built in the right way, the way we do it, let's take a scenario where the dividend rate, the total guaranteed interest plus the dividend that you're being paid is 6%, right? Mm-hmm. Over that 10 years, the 20 years, the life of having that policy, you're going to end up with about a 5% net return. Okay. So the cost is about 1% below whatever the average total dividend rate was that you earned. Mm-hmm. Right.
What does that come on an average basis points per year?
So the challenge on that is the whole life doesn't work the same way as universal life. When we build out these IULs that we're using, those are going to be about 50 basis points. The whole life policies end up being between 50 basis points and a percent in total.
All right.
But
so generally speaking, we're talking about 50 basis points up to a 1. These are not outlandish. I mean, you would think from the way that we're reading these things that they are somehow these crazy fees. I guarantee you're paying, if you've got mutual funds and stuff like that, you're paying like 2 or 3% on that stuff.
Yeah.
Not 50 basis. So 50 basis points, by the way, means a basis point is like 1/100th of a percent. So 50 basis points is a fancy way of saying half a percent. Anyway, go ahead.
Well, so I think the thing to remember here is that you're paying for something that's a value, right? So it's kind of silly. Like cost is a funny thing. If I said to you, hey, you've got to pay me 3%, but in return, you're going to get 10, right? Like who cares if I pay 3 and I get 10? So what you're doing here is if you're replacing, let's say it costs 1%, for a 5% tax-free money-producing machine that's completely liquid, which we're going to get into next here in a minute. So I think that's an important point. Like, again, paying is kind of a silly way to look at it because you're actually dramatically increasing the return on all of the money.
Yeah, well, these are the same.
Does that make sense?
These are the same guys who look at syndication and they say, well, I'm not going to split the returns with the general partner. I'm not going to do that. I'm going to invest on my own. And they're going
index funds.
Right? And then
That's
they buy their own apartment building and they don't cash flow at all or they make very little on it. In the meantime, we had Dave Steele on a few weeks ago from Western Wealth Capital, and they've got a typical 65-35 equity split at the end, which sounds expensive after capital return. But guess what? Investors are making an average of 30% annualized return. So if you are making that much money, why the heck do you care that the guy who is making you that money is making money? Like why to me, it's an issue of being very sort of narrow-minded and small, right? You just can't have a sense of abundance because you're so focused on what everybody else is making. You can't focus on the fact that, hey, you're going to make money too. It's not like if that person makes money, you don't make money. They're not taking money away from you. They're making you money where you couldn't make money. And therefore, they are making money. And so a lot of these people in this community have this like weird sense of like, I want to know what's in your pocket. I want to know. and I don't want you to make that much money. Well, good luck, because in this world of investing, you're not going to find people that are going to help you make money and do it efficiently, do it over and over again, like the way guys of Western Wealth or whoever, if they're not going to get paid. You're just not going to find it. And that's where sophistication really hits the rubber. I mean, in my view.
Amen.
Anyway, and we're talking about 50 basis points, 50 to 100 basis points. And anyway, whatever. All right. Next one, misunderstanding the importance of keeping investment costs down. Same thing, right? Same thing. He just hits this one over and over again in 3 different ways. And again, he's so worried that somebody else is going to get paid that, it's worth 3 points. Now,
and sorry, just one last comment on that is, it's confusing the whole purpose behind the policy, right?
Right.
Just to make it perfectly clear, if you haven't gotten that message already, we're not saying that the insurance policy should be your investment.
Yeah.
The insurance policy is a vehicle that we use to enhance your investing.
It's a strategy. It's a way to enhance stuff. That's the way we look at it.
Yep.
All right. The last point, misunderstanding the value of liquidity. And I just don't I don't get this one at all,
so
because
I can tell you why this comes up. I know exactly. So the reason this comes up is because he's talking again about the traditional policy that you get from New York Life or Northwestern. I probably shouldn't say the actual names of companies, but oh well. We're just letting it out. But that's the problem, right? Like,
right.
if that's the case, you will have a lack of liquidity early on to some extent, right? Now, when we build these policies, this concept is completely flipped backwards. What we do is we create the maximum capacity and the maximum amount of liquidity, because the whole idea behind this for us is to invest the policies. Whereas again, he's saying don't use this life insurance as an investment. On that, we actually agree, right? But the problem again becomes that now you're just painting this blanket over everything, when in reality, he's leading people to miss out on a lot of the key benefits that really would help them, jump from high income to high net worth.
Yeah. And I don't know if I even agree with you on that, where you're saying that, these products can't be an investment. I mean, I think the Velocity Plus leveraged IULs are a great example of that, right? If you want to have exposure to the S&P 500, do it and then lever it up. I mean, and have guardrails on it so you can't lose. You can't lose more than the interest that you're paying on the debt. To me, that's an investment, and I think it has tremendous value. The other thing is in terms of whole life. The funny thing is with the banking policy that I view that is a great way to actually keep liquidity. So it's quite the opposite, right? I mean, for me, like we were talking about this on an Ask Buck show recently, where someone said, well, should I lever up and refi my house and, take the equity out and, invest it and that kind of thing. And, the answer to that was, well, it sort of depends. The math would suggest, yes, you should, because you're going to do better on your returns than the mortgage, but there's a psychological component to that as well. So one thing that we've talked about in Wealth Formula Network, one approach to that has been, well, how about instead of leaving that equity in the house as debt equity that you're not going to invest, that makes you a massive target to creditors and to bank foreclosure, because you have a lot of equity means more likely to foreclosure, why not take that equity and put it somewhere else, like a Wealth Formula Bank policy, and grow that separately at 5.5%, 6% compounding, and have that as a source of liquidity that can't, that's sort of separate from your house. So the irony of it to me is that we look at it as a source of liquidity for investing or a source of liquidity for, where real estate investors generally don't keep a lot of liquidity. It's in that regard, it's quite the opposite. And I'm just scratching my head, wondering, what the confusion is.
Well, so here again, it comes when you take a bad experience, it just like gets portrayed on everybody. And it feels to me like this author has had a bad experience, took a stance on it, and just has never been willing. Now, I will say this, over time, I've seen some lightening up on this. It used to be really, really hard. This sounds, I'm laughing because it's pretty bad now, right? But it's gotten a little softer over time, believe it or not.
Yeah.
But I do agree with you, Buck. Like, that's a great point. We absolutely believe that Velocity Plus is the most powerful income producing retirement vehicle that exists. So I will say, what I will say is that we generally don't suggest that you buy like an IUL and you just sit there and use the, generally speaking, we want to take that cash and have it out there in some alternative investments. However, you made another good point, and that is just that for the right people at the right times, having your money sitting in the policy, earning a 5% tax-free return is not a bad place to have it sitting. And so even if you only did that, you'd be better off at least half of the time than you would in going into mutual funds.
The way I see it is that it's a good place for quote unquote safe money. I mean, listen, you could put money into, maybe you put it into treasuries or something. And what's the yield on treasuries? I mean,
right.
Not good.
Yeah. Just doing comparisons, right?
Or if you want to have liquidity sitting around, if you have liquidity, which makes a lot of sense to have some liquidity. I used to keep dangerously low levels of liquidity, and I'm kind of done with that. But but having liquidity is a good thing. I just think that when you do, you got to start to figure out where you're going to put it. And for me, banking really makes a lot of sense as a place to let that liquidity grow, and and instead of having it in something like treasuries and getting no return at all. I mean, these are strong companies, right? It's not like your life insurance dividends and guarantees and stuff are not exactly unsafe. So
180 years of the longest standing companies in the world.
Right. Anything else to add, fellas?
I think you nailed it.
It's good. Yeah.
Sounds good, guys. All right. Well, with that, I want to thank you for being on the show again, Rod and Christian. And if you want to learn more about Wealth Formula Banking, Velocity Plus, and some of the high net worth stuff that is out there, premium finance IULs, things like that, go to wealthformulabanking.com and, watch those webinars, but that's also where you can get in touch with Rod and Christian. Guys, anything else to close it out?
No, thank you for having us, Buck. We always enjoy the ride with you. Appreciate it.
Sounds good. We'll be right back. Welcome back to the show, everyone. Hopefully you enjoyed that show. And of course, if you are interested, I would highly recommend reaching out to Rod and Christian. Go to wealthformulabanking.com. You can watch some webinars on this stuff again. And listen, if you decide it's not for you, then great. That's fine. But what drives me personally absolutely bananas is a lot of misinformation, a lot of people not knowing what they're talking about, and blindly following the advice of those people, because I don't think it's good advice. I don't think it's really sophisticated advice, in my opinion. So learn about it. Talk to Rod and Christian. Have them write up some stuff. And if you want to do it, don't do it. But at least understand it. Understand it because that's the name of the game. That's why you're listening to this podcast. You want to understand what all these concepts are. Some of them are going to be for you. Some of them are not. At any rate, that's where you start with any personal financial plan. And anyway, that is it for me this week. And for the first episode of the year for Wealth Formula Podcast, this is Buck Joffrey. Happy New Year. Signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.